Hello, I'm Luca and this is the Web3 in Travel podcast, where you can learn about crypto, blockchain, and how the new internet will change travel.
Hi, we have a second donor in the podcast NFT. So somebody minted an NFT by donating a few euros to the podcast. So I'm very grateful. We also know who it is. It is Jaka from Slovenia. I know it because he came in LinkedIn to talk about it. And Jaka told me actually today that he just bought a flight to Barcelona for the Web3 in Travel conference. So thank you, Jaka.
In this episode, I am giving a general overview of what's been happening in the last couple of months, not specifically related to travel, not specifically related to even Web3 or crypto, but again, in general, because I think things are changing pretty rapidly, and it's probably important for you to know my perspective in general, so you can judge also things I say about Web3 and travel specifically. Just to make an example, if I say very stupid things on things you know probably better than me, then you may infer that the things I say in Web3 and travel are also wrong. So that gives you kind of a protection against my perceived. Often we listen to experts in a certain field and they always stay in that field and they sound very convincing, and just years later you discover the way they analyze things, the general overview on the world was completely wrong. So I'm doing this for this reason, to give you a broader perspective on myself, and also because I want to talk about these things while I talk about them, I can think about them a bit more deeply rather than just having them in my head. Even if writing is the real thing. When you write, or at least when I write, my thinking becomes much, much better. Anyway, that's what we're going to do today. So I'm going to talk about the banking crisis, the recent pump of BTC, Bitcoin, and other cryptocurrencies, the war on crypto, which has started, an open war against crypto in the US, and what that means for upgradable smart contracts and DAOs. And I guess that's enough to start it, and we take it from there. So, what happened? What happened is that we had a few bank crises. Let me explain you what I understood out of this. Again, I'm not an expert at all in finance, but that's what I understood. So the Fed kept the price of money, so the interest rate, very, very low for a long time, following the 2008 crisis. And the way to fight a crisis often is to basically print money, so bring liquidity to the market, so the assets are valuable and things get working. They've been doing this for many years until inflation appeared. Because if you create money out of nothing, there's more money around than goods it can buy. So prices go up. The thing with inflation is that it is a very hard beast to tame. If it goes too far, it becomes really, really hard to stop. So the official rate that the Fed tries to target is 2%. And it went up to much more, like I think 8% in the US, much higher in other countries. So what the Fed did was to basically stop printing money and raising interest rates, basically removing liquidity from the market, and by removing liquidity, hopefully tame inflation. Which means people and companies having less money to buy things, so prices stop growing so fast. Now, this hasn't really yet worked yet. It slowed down. Of course, we are not back to 2%. That's going to take a long time. But the rates going up had some effects. There's a way to see this is like, you raised rates until something breaks and then you stop. That was kind of the idea. Because when something breaks, you can't keep pushing. You don't want to break the economy, you just want to slow down inflation. And something broke. Specifically banks broke. What happened exactly? Well, from what I understood, some banks, specifically Silicon Valley Bank, they got a lot of deposit during the high liquidity period. And when a bank gets a deposit, it has to put it on the market. It has to lend it. Otherwise, they lose money. So what do? They lent it to the US government by buying treasuries, which is the safest asset on earth because it's guaranteed by the US government. So you may think that that was a safe move, but it turns out it wasn't, because what they bought were 10 years treasury bills, which means you can buy them today for a certain price. In 10 years, you get back the exact same amount of money that you put in, plus the interest. And I think the interest was like 2% or something, or even less. A low interest, because they did this when the rates were very low. Now, the Fed for a long time signaled that they wouldn't raise rates. And then, well, they signaled many things like inflation was transitory, for instance. So that it didn't work out as they planned and as they said it would work out. And so they rose the rates, and what happened is that the treasury bills, 10 years treasury bills, were paying, let's say 2%. But now the 1 year treasury bills were paying much more, like 5%. Don't focus on the numbers. I'm kind of randomly saying numbers here, but it means that if I have money and I want to get a return, I'm not going to buy a 10-year treasury bill from Silicon Valley Bank, which is paying 2%. I'm buying a 1 year, so it expires earlier. I can get my money back earlier from somebody else or from the government directly, which in turn, and this is the important part, made the value of those 10 years treasury bills go down. So let's say that SVB, Silicon Valley Bank, henceforth, paid 100. If they want to get the money back now, instead of waiting 10 years, they're going to get 95. All right, so they lose money. Now, what happens when you have those kinds of assets on your balance sheet worth less than you pay them? Well, you have a loss. And what happens if your depositors come back to you and say, I need my money? Well, you don't have enough money because you have them at a loss. So you actually have a hole in your balance sheet, and you have to really hope people are not starting to get money back. And so they try to raise money to fill this hole, because it's a temporary hole, right? It's like the money is there. In 10 years, it's going to be there fully, plus the interest. But now we have a problem. And the problem with Silicon Valley Bank was that their the depositors were mostly startups. And startups don't keep the money too long. They burn the money, right? They use it. So there was a mismatch between the deposits and the liability, the lending they did, which means that they were very, very sensitive to a bank run. So everything would have been perfect if people wouldn't start getting money out. Now, what happened is that somebody wrote an article about their financials. They read the financials, and in the little footnotes, they saw that their treasury bills were actually underwater. And so they wrote about this. That was a Substack, not even, Wall Street Journal or something. It was like citizen journalism in a way. And, well, people took notice and started withdrawing money. And then, when you hear that people are withdrawing money from your bank, you don't want to be the last one. So you run to the bank and get your money out. And then it becomes the classic self-fulfilling prophecy, in which if everybody's taking the money out and the bank doesn't have all that money, well, the bank goes down. Somebody will lose the money unless the government helps. And that's what happened. The bank was shut down. The depositors were made whole by the government. So the government said, don't worry, the money's going to be there. How? Well, by printing it, basically. And we had this bank run. Now, this is interesting because every bank, basically, no bank has all the money of the depositors ready, liquid in this moment. Otherwise, how can they lend it, right? So every bank is basically at risk of a bank run. And that's why there are insurances like the FDIC, which insures your deposits up to $250,000. This is the American, the US way, and then there's different things in Europe, etc. But this is the same concept of every fractional banking system, where you say, okay, we all know the money is not there, and this is as planned. But if something goes wrong, banks are paying an insurance to the FDIC, and every depositor under $250,000, we get the money back no matter what. That was another problem with Silicon Valley Bank, that most depositors had much more than that. They were startups, they had millions or more in investments. So Silicon Valley Bank goes down. Okay, goes down, and it's the result of a few things. And again, this is what I understood, not what I think, because I'm not an expert, but that's what I understood from following that. Well, one thing is that the Fed promised one thing and did something else. They promised they wouldn't raise rates very quickly, and then they did it. Of course, they gave time before they did it. So any, let's say, conservative bank would have had time to react to this. Another thing which happened is that Silicon Valley Bank didn't hedge the risk. They knew they had a risk with this long exposure, and they didn't hedge it. Why? I have no idea. Maybe, greed. I don't know. Anyway, they made a mistake. It was a badly managed bank. And I think what is left of this failure is the fear of people in Silicon Valley. We tend to think about banks as safe places. And for a couple of days, with more people, like startups, were really, really scared. And when you're scared, fear is a strong emotion. It leaves scars on you. And when you, for 3 days, were sweating, thinking I'm going to lose all my money, you don't go really back to normal. You go back to normal, like, okay, the money is guaranteed by the government. But in the back of your head, you're probably thinking, maybe banks are not that safe, are they? And we'll see how this plays out in the longer term. Now, one personal experience I had with Silicon Valley Bank is the following. In 2014, I raised some money for a startup in Bulgaria, and we opened a company in UK to raise more money. It was easier to raise through UK than through Bulgaria. And we opened a company in UK, and then we needed a bank account, and surprise, surprise, nobody wanted to give us a bank account. No one. So somebody suggested, you know what, Silicon Valley Bank has a branch in UK, and they are, startup friendly bank. Try with them. So I applied with them, and we went through this approval process. And I remember very well, one day I was somewhere on the road with my car, and I got a call from Silicon Valley Bank, and they said, look, we are okay, we want to get you as a customer, but you have to remove every mention of Bitcoin from your website. Now, why did I have Bitcoin on my website in 2014? Well, because I got into Bitcoin in 2013, and at the time, Bitcoin was all about, let's use it as a mean of payment. So I had this Airbnb before Airbnb thing. Well, actually, 2014 wasn't before Airbnb anymore, but I had this platform with apartments, and we started placing many apartments on a website called, I think, CoinMap, which was basically a Google map showing you where you can pay with crypto. With Bitcoin at the time, no crypto at all. And so we had many apartments, and people were actually finding them, and they wanted to pay. We had just started that. We did a lot of work, and people hadn't really started trying to pay with Bitcoin. It was after a big crash. It went from $1,000 to $300, and people were still holding on Bitcoin, right? So we did a lot of work to put all these apartments one by one on this map, and but we didn't get bookings yet, right? Remember, the Bitcoin was about $200 at the time for one Bitcoin. Today is 27 or something thousand. So, all right, we had to decide between this maybe Bitcoin payments in the future or a Silicon Valley Bank account to raise money. So basically, it was a fight between Bitcoin and fiat money, and we said, okay, let's remove Bitcoin and go ahead with the Silicon Valley Bank. So we removed it, and well, I forgot to say why would we have to remove Bitcoin? She said Bitcoin is really dangerous. It's toxic. It's not regulated. It's dangerous for you. Basically, that was the concept, right? And so we removed it. We never raised money on that company. Then I shut down the account in SVB. Shut down the account. The company UK was totally useless, and we didn't go back to accepting Bitcoin for some reason. That was like a couple of years later. What happened after we removed Bitcoin payments in our account was that people, after a year or so, because Bitcoin price wasn't moving, people started looking for ways to spend it, right? And we started getting people's requests to say, okay, I want to make a booking with Bitcoin. I want to pay with Bitcoin. And remember, $1,000, apartment for a week, that would have been 5 Bitcoins. And the idea for us was to keep those Bitcoins and just keep them for long term, as in general, right? We did later, personally too. And we said no. And we said no so many times until we started thinking, well, we should put them back, right? By the time we decided to put them back, things had changed. I think the company was doing something else. Bitcoin started pumping, so people wouldn't want to pay anymore in Bitcoin, because when Bitcoin is growing, 200 euros today, 300 tomorrow, 500 after tomorrow, you don't want to spend it, right? So we lost that window. And when I go back and I think that if I had 100 bookings paid in Bitcoin, I would have had millions or 10 of millions. Because the idea was to get paid in Bitcoin and keep our commission and pay out to the owners in euros or whatever we were using at the time, because most of the bookings were actually made in euros. So big opportunity lost, but there's not a problem. I mean, when you are in crypto for a long time, you lost so many opportunities and you had so many good things happening to you. It's just one of the many things. The funny thing is that Silicon Valley Bank is dead now and Bitcoin is alive. Now, what happened also on the sidelines with the Silicon Valley Bank debacle? Well, they shut down another bank called Silvergate. Silvergate was one of those banks serving crypto, one of the few banks serving crypto companies in the US. And it's been shut down. So the FDIC came in and said, we take over. You are done. And they took over. The thing is that bank had no problems. The bank was solvent. I think it wasn't fully liquid, but it was solvent. So I'm not going to go too much into detail here. But what happened is that one interpretation of what happened is that in the fog of war, they found a way to shut down a crypto bank. And that was later confirmed by other actions and other documents coming out that basically the Biden administration has gone fully nuclear against any fiat on-ramp for crypto companies. They want to stop crypto in the US, basically, by making it very hard for crypto companies to have a bank account. Now, it is legal. No, of course it's not legal. I mean, if you don't want crypto companies, you make a law and you say you can't do crypto here, and then crypto goes away. But they cannot do that. Well, because probably there's no political consensus on this. And there are some states in the US which are pro-crypto. So if you go through the democratic process, you don't stop crypto. That's basically the bottom line. So you have to do other things. And this is called choke point 2.0. Choke point is, if you want to kill an industry, just stop their banking on-ramps. They did this in choke point 1 with Obama against gambling, maybe and some other industry, the cannabis industry. This is choke point 2.0 against crypto. And it's basically an extrajudicial way to stop crypto. Now, they really have gone hard on this. And this is from today that even Binance has been strongly attacked. I haven't yet read everything. So take it, simply the US is fighting crypto. The US federal government is fighting crypto very strongly. Now, let's put these two things together. And I may sound a bit conspiratorial here, but that's how I see this one. This is how I see it. This is my interpretation. So you have, on one hand, the fiat system, which is going through a systemic crisis. So we had Silicon Valley Bank, Silvergate, a few other banks like Credit Suisse. Now they're talking about Deutsche Bank. There's some issues there. And the solution with this is to print more money. Okay, let me be more clear here. They're not printing more money. They are guaranteeing deposits, which means they don't print money until it's needed, basically. But it's kind of backing the liquidity. It's basically saying, and some of these people said, there's infinite liquidity, infinite money, right? So you have the fiat system, which is suffering because of excessive printing, which actually means excessive spending, the rules from the government. And has it happened often in many other countries, when your fiat system is in trouble, you close the gates. You don't let people exchange their money. This happened countless times in history, right? It never happened in the US with the US dollar, but it looks like it's happening now. So they know that the fiat system is unbalanced, and in order to make it work, they don't have to allow people to get out of the fiat system. Now, if you buy a house with your dollars stay in the dollar system. Yeah, you have an asset. It's much better than holding dollars, of course, but you move dollars from one bank to the other. When you're buying Bitcoin, you are exiting the system. It's like if you are in Zimbabwe and your money is hyperinflating and you buy dollars. You're exiting the Zimbabwe dollar, making it even weaker. And this happened, I was in Argentina many years ago, and I remember that also I was in Venezuela. The exchange rate, the official one was one thing, but the one on the street was a different one. They would give you more dollars on the street because the real value of the Bolivar or the peso was actually much lower than what the government would want you to kind of think, right? Now, if you add to this the geopolitical situation in which countries like China and Russia are trying to get out of the dollar, or at least not use it always for everything, you can see how important it becomes for this fiat system to not allow easy exit for people, right? And the same thing is for the euro and any other fiat currency. The Bitcoin price went from $16,000 in January to $28,000 right now. Well, now it's 27. So the narrative that Bitcoin is a decentralized store of value, a decentralized potential money system, etc. So some safe haven from the fiat mess got stronger. This is an old narrative. This is 10 years old. It's nothing new here. Oh, more than 10 years old. So it's kind of playing out in the way that Bitcoin or Bitcoiners or people, believing it, said it would play out. So this may be the beginning of hyperinflation. I don't know. But let's talk about Balaji. Balaji is a Silicon Valley entrepreneur. He's been CTO of Coinbase and the general partner at Andreessen Horowitz, which is a VC. And he came out with the Bitcoin signal, saying basically that we are entering an hyperinflation moment in the US dollar, and Bitcoin will go up to $1 million in 90 days. And he said that was a way for him to raise the alarm. Then somebody made a bet saying like it's not going to happen. So now they have a bet running about this thing happening in 90 days, etc. Now, I'm not going to tell you that Bitcoin is going to $1 million in 90 days. I just want to tell you that some people are starting to look at this as a very important moment in the history of fiat currencies, and things are kind of running out of hand. I don't know if this is true. I don't think it's gonna go to that, and I hope it doesn't go to $1 million in 90 days. I just want to pass you on the information that some people are getting scared, I would say. What happens if Bitcoin goes to $1 million in 90 days? Well, it doesn't mean that Bitcoin is going to be worth a lot. It means that really the US dollar is going to lose a lot of its value. So with $1 million, you probably wouldn't buy as much as you can buy today. Basically, you would buy what you can buy today with $10,000 or $100,000. But this is hyperinflation. This is not Bitcoin getting more valuable. Now, I learned to analyze things not from the face value of what people say, but from the tangential happenings. I'm saying this in a very bad way, but basically what makes me think something is up is this war against crypto, the war against the on-ramps. Why are they pushing so hard for stopping people to get out of the system if the system is sound? Remember Soviet Union? Remember when at a certain point everybody, not everybody, but many people wanted to leave the Eastern Europe country or the Soviet Union because they realized after a few decades that the West was more prosperous. And remember how many people in the West wanted to go to the East? I would say nobody, right? So you always have a system which is more attractive and a system which is less attractive. And the system which is less attractive builds the walls. Now, the Berlin Wall was built by the Soviets, right? Why? Well, because people wanted to leave. Did we have a wall in the West not to go there? No. I mean, we could travel to Prague and as a tourist, and we didn't want to stay there, right? We just wanted to see the buildings. So it looks like they're building a wall against around the US dollar because they don't want people to leave the US dollar. And I say US dollar, but it's actually the whole fiat system. So I'm seeing a wall being built, and that makes me think that something is up more than any other event. Bank failures. Okay, banks can fail. Actually, banks should fail if they are mismanaged. Printing money, fine. This is the system we are in. It's money is fiat. It's printed according to the needs, etc. Fine. But when you are making it hard and in such a hurry for people to get out of your system, I start questioning your system. Now, I personally have started questioning the system a long time ago, so it doesn't surprise me. But this is a hard fact. So look at how hard it's gonna get to exchange your euros or dollars for crypto, and that's the measure of how the system is fragile. I mean, the fiat system is fragile. On the other end, is crypto safe? Well, that's a big statement, isn't it? Of course, if there's a war, I don't expect simply crypto to go up. I want to focus on Bitcoin here because then crypto is a much wider subject. That I'm not expecting to, I put all your money in Bitcoin, you're going to be safe. No, they're going to fight Bitcoin with all they can, right? And this is the US, it's not Venezuela. So it could get very, very nasty. I don't know what to do other than differentiate. Okay, so I'm not here telling you what to do. I'm just telling you something is up. The signals are worrying. I wouldn't have all my bets in one basket, which is the US dollar or the euro. I would differentiate. Yeah, and I think I forgot to mention one important aspect. So if banks are failing because the fractional reserve banking is very sensitive to bank runs. So first of all, let's talk about this, bank runs. Banks as they are today, they were conceived in a time where to get your money out, you actually had to go there and wait in line or it will take a long time. What happened is that in the meantime, we started allowing people to get money out very quickly through an app. So a bank run today happens in minutes, hours. There's no more queues. The queue is the server serving requests. And when you start making a request on your app to get money out and you get an error, then you panic, right? In the same way as you panic when you go to the bank and there's a long queue, or they shut down the bank, as they did, for instance, in Argentina. But that happens much, much, much faster, all right? Did the banks adapt to this technologically? Or actually not technologically, did they adapt by having more reserves? I don't know. I don't think so. You will probably need to have 100% reserves or 80% reserves. Then how do you lend money if you need to have the money ready? There's something I don't understand too much in banking. It's like I put my money in my account, and they tell me you can get it out anytime you like. And you put your money there, everybody puts the money there, and they say the same thing to everybody. You can get your money out anytime you like. But that's not true, because they take the money and they lend it. All right? So by default, it's probably a statistical thing like, okay, not everybody will want to get the money out at the same time, so we can lend a part of that, right? But today people can, just because a tweet, somebody said that bank is insolvent, everybody's going to rush from their living rooms to get the money out. So there's something I don't understand how this is conceived. And the solution is to say, okay, don't worry. There's the government behind this. There's infinite money in this case, which is, some say, encouraging banks to take more risk than they should. And historically, they've done this and it never ended well. And here you go with another weird thing, which they don't talk too much about. There is a bank called Custodia Bank in the US. The founder is Caitlin Long, who asked the authorities to have a bank where they keep 108% of the deposits, making it impossible for a bank run. So if the bank run comes, everybody gets the money out, they still have all the money plus 8%. And they were refused this charter. Why? Well, again, you can do a bit of conspiracy here. Why would they not allow a bank to have more deposits, more reserves than deposits? Maybe because everybody will put the money there. Maybe because they have other plans. And all right, okay, let's talk about that. What happened with the Silicon Valley Bank debacle is that everybody started moving money where? To the four big banks. Four big banks, like I think it's JP Morgan, Wells Fargo, I don't remember, I don't know them. And so we will see a big concentration in banks. And when you have concentration, you tend to have more control. One thing about the American banking system is that it was really decentralized. Thousands of banks, I think, not even hundreds, thousands. We don't have so many in Europe, right? And it's getting centralized. Centralized is always a bad sign, but that's what's happening. And let me talk about another thing here. I'm going fully conspiracy here, but I don't think I am, to be honest. You have heard about CDBC, central bank digital currencies, and they are still far away. It's going to take time, etc. In July, the Fed is going to launch what they call FedNow. Okay, FedNow is a Fed instant payment service set to launch by July 2023. I'm reading EU Finance. Let me read that. The Federal Reserve is on track to deliver an instant payment service called FedNow between May and July 2023. The central bank's clearest timeline yet for a new system enabling settlement of US payments in seconds. The FedNow service will transform the way everyday payments are made through the economy, bringing substantial gains to households and businesses through the ability to send instant payments, etc., etc. This is not exactly a CDBDC, but it really goes in that direction, in the fact that the money is issued by the Fed straight to your wallet, which is great. What is not great in general with CDBCs is that they can stop your wallet for any reason. They can put an algorithm saying you have to spend this money before a certain time, or you cannot spend it on cigarettes, or whatever they decide. Oh, you didn't vaccinate. I think I talked about this not too long ago. So there's not a signal which is telling me something is up. It's accelerating. One, making it harder to get your money in and out of crypto. Two, concentration of banks in the four big ones. Three, the FedNow system. It's enough to start thinking about what's happening and paying a bit closer attention. Because what happens when the walls are up and the payment systems are like FedNow? How do they solve the problems which we are in? Well, they simply print more money. They inflate the value. Well, they inflate the dollar, making what you already have in fiat loses value. That's how they get the money back, the money which was lost, by inflating out all this debt, basically. All right, I'll stop it here. Again, take this not as a well-informed take on the global economy, of which I'm not an expert. Take this as a signal, maybe to start looking into that direction. Maybe there you will be able to analyze yourself what's happening, probably much better than me. And feel free to come back to me and tell me what you think about this. And if you don't agree with anything, I'm really open to discussion here, because I am as confused as anyone, but I am keeping an open mind. I don't think we can afford here to be sure about anything in the next years. We need to be flexible and try to get all the information and all the perspective we can to navigate the next years. I am trying to build a map on which to navigate, and I don't believe the official map anymore. So I'm trying to build my own, and this is hard, and it's very easy to make mistakes. So the more we interact on those things, the more we try to create a realistic map, the less our boat is going to hit the rocks, so to say. Okay, let's talk about something else much more crypto related. Specifically, let's talk about smart contracts upgradability. What does it mean? It's connected to all the rest, yeah? So don't worry, I'm not completely changing the subject. Well, a smart contract by default should not be upgradable, right? You launch the smart contract, you can't change it, it's just there, people will use it. Now, this is a very difficult way to launch products, because you launch a smart contract, you realize you want to change something, you can't. You have to redeploy a new one. So before you launch any version, you have to be very careful. So what's been happening a lot recently has been like, okay, why don't we build upgradable smart contracts? Like, yeah, it's mutable. We can change some parameters, right? And that makes it much easier to ship products, easier to update them, easy to fix bugs, etc. But at the same time, it kind of kills the whole idea that smart contracts are immutable. Where is the right balance? Well, it really depends on the use case. There's no easy answer here, but the whole Web3 industry, the crypto industry, fell for the comfort of uploading smart contracts which are upgradable and say, don't worry, we are the good guys, which is a very dangerous thing to say to yourself and to the others. What turns out, what has been happening recently is that from the US, again, judicial system, it looks like, and why wouldn't we agree, that if your smart contract is upgradable, well, then you are responsible for what's happening with the smart contract. You become a custodian, right? Let's say that you have a booking smart contract where the guest pays, the money stays in the contract in escrow, and then it's released to the hotel, the apartment after check-in. And you do this with an upgradable smart contract where the owner of the contract can withdraw the money at any time. This is custodian. The owner of the contract is basically keeping the money for you. On the other end, if the contract is completely autonomous and immutable, it's the code which is taking care of that money and releasing it on the day of check-in, right? So from the legal point of view, and again, why wouldn't we agree? If you have a mutable, upgradable contract, you are responsible for that money. You are a custodian, and that completely changes the equation. So that's just to say, let's be careful with taking the easy route, which is let's keep contracts flexible, because that flexibility has consequences. So another way to do that will be to allow some upgradability, but only through a decentralized voting system where token holders can vote, and if the vote passes, and there's a direct connection with a transaction which makes the change. So there's not one person who can decide changes, but it's a whole token holder basis. Another piece of news which is pretty much related is there's been a ruling in the Sarkoony versus BZX DAO. There's a class action against a DAO in which the court has denied the motion to dismiss of member of the DAO who held governance tokens, finding the DAO is plausibly alleged to be a general partnership. This is basically saying we don't simply say because there's token holders in the DAO, then the only responsible people are the people who funded the DAO, but also the token holders. It's not a ruling saying that, but it's going into the direction. And so the next question is like, is your DAO really decentralized, or you just, and in this specific case, it looks like those guys simply said, okay, we don't want to be responsible. Let's make a DAO. They made some tokens, they gave them around, and they kept control actually because they had the majority. And the court is saying, no, you can't do this trick. If it's decentralized for real, it's decentralized. Otherwise, you're just doing some decentralization theater. I don't know the specific case. I'm not following, but we weren't even talking about DAOs a couple of years ago. And the far west period in which you can do anything you want as long as you call it a DAO, it's kind of over. The lesson I draw from these news is that if you want to do something decentralized, do it really decentralized. If you want it, and which is hard, if you don't want to do it too decentralized because it's hard, well, do it as you want, but be clear and take responsibility. And we will see a lot of these tensions play out in the travel space too. We will have those DAOs who are not really DAOs, DAOs who call themselves DAOs, but they are centralized and they're going to decentralize later. We're going to have real DAOs and with, complicated setups. And people would say, well, I'm going to go to the other one, which is easier. And then it turns out it is centralized. So there's a risk in the people running it. We're going to see these things a lot. Let's learn to understand, and I said this before, if there's a mismatch between what the founders are saying and what's actually there. So if they come out with, we are a DAO, and then we are able to look into it and say, no, you're not a DAO. You're just calling yourself a DAO. Let's learn to do that because it's going to help us, again, navigate in the travel space in the future. And well, since we're talking about DAOs, let me end this episode talking about the Web3 in travel DAO. So the DAO we are setting up for the conference in Barcelona on the 15th of May. I haven't yet launched the NFTs. I'm planning to do it in the next days. We will mint some NFTs and give them to people who helped in the process of creating this conference, organizing the conference. And at the first step, we're going to give it only to people who helped consistently and actually brought some value, not to those who only participated to a few calls and did something here, something there. We're going to try to, start slowly by giving only to people who are really involved. And the reason is, apart from the fact that you are part of the DAO if you're really involved, that in our specific experiment, the DAO is formed of every safe signer, safe owner. So if you're part of the DAO, you have a key to the treasury. And this is really delicate. If you start giving keys right and left, people will not vote, or they will, vote. The people will not sign transactions and the money gets stuck. This is a really high risk. So because this specific DAO is not going to be done only for this conference, but it's created in the occasion of this conference, and we want it to be a solid framework for future conference too, we're going to take it very slow. So we're going to give a few signatures to people who are there. They have the attention on the DAO. People we have a good expectation that they will actually sign the transactions when needed. And then slowly we're going to give more of them. Maybe even talking about delegation of voting. Again, I'm saying the word voting, but actually of transaction signing. So we're going to take it slow. Because, again, a decentralized system is very resilient and very delicate at the same time. If it's not created properly, it crashes in a minute, especially when it loses attention from the people in the DAO. So, again, just to remind you how this is going to work, if you are part of this DAO, you get a signature in the safe. So you are one of the people who approve or not transactions to move the money around. And the whole money is managed by everybody. There's nobody with extra privileges, not even me. And you can get a signature in the treasury by helping or by putting some money into it and becoming a signer, which is also helping. So that's where we stand. It's really experimental. There's not much money in it, so I'm not too worried at the moment, but it's going to grow very slowly. I just wanted to clarify that by doing this, we want to make a very tight system in which the vote and the transactions are connected. Because in many DAOs, you vote with your tokens, but then there's no automatic system which actually executes the vote. So you vote with your system and people say, okay, now because we voted, to give a grant of $10,000 to somebody, we will do it, and then they don't do it. Maybe they say, we don't agree with that, and then why are we even voting, right? In this specific DAO, the vote is the transaction. So if people agree to do a transaction, it's going to happen. If people don't agree, it is not going to happen. It's automatic. All right, I hope this wasn't too dark as an episode. Every time you feel that things are going to hell, remember that things have been going to hell forever in this world. And there's always strong dynamics towards centralization and others toward decentralization. All we can do is to push in the direction we think is better for us and everybody else. And I personally believe that crypto is one of those forces toward decentralization. And I'm trying to do my part. And I hope you are part of this journey with us. And we're done. Thank you for listening to this episode. For more insights, follow me on Twitter at Tripluca, TRIPLUCA. If you enjoy my podcast and want to support it, head on to podcast.web3intravel.com, 3 is a digit, and mint an NFT. If you want to sponsor it, you can do it at the same page. I will mention you in the podcast, and your name will appear on all donation NFTs for a while. Thank you, and ciao.